Okay, hello fellow traders and welcome to another FX Evolution video. Today is the 24th of the 2nd, 2020, and today we're going to be talking about the coronavirus global outbreak and of course the spread as it gets through Korea and starts to rise in numbers, of course Japan and Italy outside of China. So the market's starting to take, I guess, the coronavirus quite seriously. The longer, of course, this virus maintains, I guess, its hold without having some type of vaccine and starts spreading, the more the market is going to be concerned about things like global growth and, of course, hitting those numbers in terms of what Wall Street and everybody else does expect. So we're going to be covering quite a few topics today, but just to quickly summarize, we'll be having a look at the 2010 and 2018 crash on the indexes and learning from that experience. We'll be looking at, of course, today's price action due to the coronavirus spread and what the market's currently doing and what it may do next in terms of technical analysis. We're taking a look at 3 different tips that we like to use during high volatile times. And of course, we'll be using 3 different moving averages. And that is the red moving average, the 20 moving average, the blue moving average, the 50 moving average, which are both EMAs, and the 200 moving average, which is the green one, and that is an SMA. So let's get right into it and start talking about what we can expect. Okay, so here we have the VIX, the volatility index, and we can see that it's starting to spike up quite a lot higher. So we've got the VIX sitting at around 19, and usually whenever the VIX gets above that kind of 20 area, we're starting to see some high volatility, and we need to be aware that when a market starts selling off, like an index, usually it sells off or will sell off more aggressively than it buys up. So we'll see very high volatility, and therefore we may need to change our trading system. A lot of people don't realize that when volatility comes in, their spike can be down to the downside, but there can also be an incredibly quick reversal. So by day trading or scalping this type of news, we usually will have a higher level of success because, of course, we're in and out quicker, but more importantly, we are being market adaptive and we're recognizing the current situation. So generally, I like to see the VIX above 20. When the VIX is above 20 and we're seeing a break of a key support line on the way down, that means high volatility and therefore large, quick, aggressive moves, the type of thing that we want to see as scalpers. So just to get started, we've got the ASX 200 here. There's things to learn about this one. We will come back and cover it, but I do want to mention that we've got this level of role reversal. So 1 resistance, 2, 3, bit of a double top and an intervening trough. And the important thing is this pattern here. So we're on, of course, a daily time frame. That's, of course, not where scalpers are going to be. And many people are going to say, well, wait, I'm scalping, I'm not day trading in terms of daily candle trading. But this is where a lot of scalpers go wrong. It's important to understand money flow and understand that when these kind of levels are broken, that means a significant amount of risk off or people getting out of positions. It will trigger certain margin calls. It will trigger certain events to happen. And that's usually where you see that aggressive move. So it's very hard to be the person up here, but it's very easy to be the trader down here at the 68.84 level. So very, very important to understand that before we go in. And that's one of our top tips of today. We want to use larger time frames. Once we see key levels broken or we see patterns, then we are going to get involved in those types of trades and we're going to start scalping or day trading the market. So let's learn a little bit from history. So first off, I'd just like to start with the ASX 200 during 2010 crash. So this isn't the same kind of news event, of course, as the coronavirus, but it's another high volatile time. So what we have is we have resistance points, obviously up here, and up here. Kind of taken the distance from kind of the middle point, and they're all very, not exact, but they're all very similar kind of highs. Now, when the price gets through this zone, this key level of support, this will be when the market is pushing through. We would have seen a volatility spike on the VIX. So key tip number 2 would be check your volatility indicator, especially if it gets above 20 and it keeps rising. The more it's rising, usually the faster that market's moving. And then of course, we could predict at this point that it makes sense when it breaks past this zone to get down to this kind of 4,040 area. That was previous resistance. And this would be where if I was scalping it on a 5-15 minute chart and following it with moving averages, then this would be a great zone. But it's important to also note that generally when a market is highly volatile and it's getting above that 20, 25, 30 VIX, the market will usually overshoot your level or your technical level by a factor of around maybe 20 to 30% more. And the reason it does this is because the market likes to trap a lot of people into the trade, but it also likes to stop or hunt and kind of the trades themselves, and also cause that fear where I guess nowadays they'll call it weak hands in the market, where somebody will of course close trades early. They might close their longs in the market, get a bit scared down here, it becomes too much for them, and then of course that quick rebound. Now, the main reason I have the 2010 one up is pretty much because it was all over in one day. Incredibly quick movement. You've got to recognize that this is a very fast opportunity that you want to be part of. So here we've got 2018 and of course the crash. Specifically, I'm focusing on that low liquidity time that happens because this is the one that's more predictable. And this happened, of course, up until Christmas, and many people that are trading out there would remember this. So we've got this key area has been broken. When this key area is broken, we know that this is a channel break because we've got a series of kind of highs and lows that are very equal. The distance of that is going to be this point here, and we also see that further breakout that we expect with that slightly larger kind of 20 to 30% on top of what we're seeing. Now, if we go to the 15-minute, same time, same date, basically what we're doing is we're trading this market down, and we're going to use probably a 15-minute chart. And what I like to do is we usually get in based on a 4-hour break, close confirmation, we get in on the 15-minute, and then we might follow this type of trade down by anything like the 200 or the 50. Now, important to note that it's not always going to be the same. Sometimes you'll see the market where it will come down, it will respect the 50 and it will keep respecting the 50, and it will be even more volatile than this, and it will just continuously bounce off that 50 all the way down. Once you've seen 2 pullbacks to 3 pullbacks at the same moving average, and you're already in it because you're already holding this trade, and you initially put it behind that 200, once you see that happen, you can pretty much follow using a moving average behind. So that might be, let's say, a 60 or a 70 moving average that you put behind, and you just follow that trade all the way down. And that's much better than a trailing stop loss. So when it comes to scalping, use moving averages as a market adaptive stop loss, and do not use fixed pip trailing stop losses. Now, if you're wondering, oh, well, we might have got stopped out here on the 200 moving average, I wouldn't despair too much because you get lots of opportunities in this scalp. We know that the market should go down to this zone down here, the 2440. So therefore, if we got stopped out here for whatever reason, when it breaks a great support like this, the 1-2 touch, and it breaks through, we can get back involved in the market, follow it down. We know it's going to probably have that kind of more aggressive move, so we can add the distance and then add 20 to 30% on it, maybe take some of our orders off here and some of our orders off here, and have a really good kind of day trade / scalp. This isn't over that quickly, but it's definitely over in only a couple of days. And this is quite a significant move on the stock markets. So that's one way that we like to look at the markets, and using moving averages, whatever they may be for you, is a great market adaptive stop loss to be able to follow trades behind. Much better than a standard fixed pip trailing stop. So let's just go back to the ASX 200. Here we have, as we mentioned, that kind of double top. I'm sure there's MACD divergence here, the intervening trough, and the distance between the top and the bottom, which is a standard pattern for double top. So what happens if the market gets under this zone? Well, it's pretty simple to us, I guess, what we would be doing. We'd be looking at this range, taking the range that we expect, putting that on the chart, putting our support line in, going maybe to a line chart, seeing whether there's previous supports, which there definitely is, seeing kind of the round psychological number that we want, which is probably going to be about that 6,600, put it a few points above 6,605, and then that is pretty much going to be our target if this level is broken. Then we move down to the 5-15 minute charts and we start to look for opportunities to short, and we get involved with those with our dynamic stop loss being the moving averages. So hopefully that helps everybody today. Good luck, of course, when trading out there, and we'll be back next Monday with another trading tip.